The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Wednesday the 29th, 30 to the European close, 30 minutes that is. Let's talk about what you need to know out of Europe this hour. Stocks are bouncing, bonds are bouncing. This all after yesterday's sell-off. We're still on track for a negative month, and many people are pointing to the fact that maybe today feels a little bit like a dead cat bounce. The UK is calling up its reserve tanker fleet to boost fuel deliveries, despite the government saying that apparently the situation is stabilising. And Rolls-Royce, talking of petrol, is ditching the V12. It's going to go all electric. We're going to be joined by the luxury car maker's CEO later this hour. As I say, equity markets are a little higher. We've got a bit in the bond market. Yields are lower. We are looking at a pound, though, that is being put under pressure. The stock 600 is up by 0.7%. The pound is down by 0.8%. Got a really big pickup off the Bank of England last week. We've certainly faded that move quite aggressively. Down below 135. There's a lot of things happening in the UK at the moment, a lot of stresses and strains. It's kind of emblematic, Alex, of the inflation narrative that we're talking about, the shortages we're seeing on the supply side. Yeah, and then here in the US, it feels like we're reversing the move that we saw yesterday, with the exception of the dollar. I mean, the Bloomberg Dollar Index up again. You were just talking about it, up 0.5%. Part of the sterling weakness may be because of sterling, but the other is because the dollar is quite strong. Yesterday, it was about being a safe haven bid. So what is it about today? Is it better growth here today, better recovery here today? Equities higher, yields lower, crude higher, despite the fact we saw that inventory build, Guy. Yep. So Bruce Richards has his Warbies on. Stacey had her Warbies on. I probably need my Warbies to read this, but Warby Parker indicated to open at 50 to 52. This after the direct listing. It was interesting what Stacey Cunningham said down at the NYSE about the fact that maybe choppier markets point you in the direction of direct listings. I think that's going to be something that we're going to pay attention to. But it looks like it's at the moment 50-52. We'll keep you up to speed with exactly what it's going to look like when it goes out of the door. Let's turn back to what is happening with the European economy. The Irish Central Bank Governor and ECB Governing Council member Gabriel Marklouf says that policymakers must be ready to respond to persistently higher inflation. He spoke to Bloomberg's Francis Lacroix a little earlier today.
That's the risk that we at the ECB need to be very conscious of and very aware of and ready to respond to if it happens. Of course, the pandemic could have also resulted in structural change that pushes in the opposite direction. So right now, I think it's the key word, I think, is vigilance.
Okay, let's talk about what higher rates potentially could mean for the credit markets, both here in Europe and around the world. Winnie Cesar, CreditSight's global head of strategy, joining us now. Central banks, even the ECB, is now pointing us in the direction of the potential for rates to go higher. We saw a big repricing yesterday. Relative to history, it wasn't that big, but where we are now, it feels substantial. What does that mean for the credit portfolios that you look at?
Well, it means that we're sitting on some total return losses, which probably doesn't feel particularly good for a lot of credit investors. And that really affirms our outlook that investors should be preferring credit risk to duration risk right now. Curves are exceedingly flat, even with this recent move in yields that we've seen. And economic fundamentals are still recovering and pretty much on pace to remain really intact from a credit perspective, despite the fact that we have a lot of headaches when it comes to inflation.
It does seem, though, that the UK and the US, for example, may be on a touch of a different trajectory when it comes to the ECB. I mean, look at the move in break-evens. Break-evens higher here, not really moving anywhere in Europe. Real rates moving higher here, not really moving anywhere in Europe. And I wonder what kind of relative opportunity that might unfold.
Yeah, that's a really good point. And, you know, in the UK, you obviously have compounded headaches related to Brexit with supply chain and labor and inflation. And I think that it's really important to consider that the Fed is the really significant driver of global monetary policy. The US markets are the most liquid, they're the largest. And so when investors are kind of considering global relative value, particularly in fixed income, I think that the US is going to lead the way in a little bit because a lot of investors are viewing the US markets as a cash surrogate right now and really keeping a keen eye to the Fed. And then just expecting a lot of the other central banks to be a bit more of a follower, despite the fact that we have seen some hawkish messaging and tightening from some of the European central banks, from some of the EM central banks. And so it's a really interesting kind of study and contrast right now across fixed income and the rates markets.
Companies still have a lot of cash on their balance sheets. Should we be worrying about the credit market in this kind of environment? There's a lot of stresses and strains on companies, but companies have cash. Where do you think that the stresses and strains, therefore, are going to show up as we start potentially to see rates going higher? We potentially see tapering coming through from the Fed and potentially the Bank of England as well. How big a buffer do you think that cash is going to be?
I think that the buffer is pretty tremendous right now. Over the past 18 months, all we've done is see issuers really load up on cash, really fortify their balance sheets, and try to make sure that they have enough liquidity to preserve for a rainy day or for more challenges to come. So the big question that I'm asking myself and talking to investors about is, over the next 3 to 6 months, how do companies start to use that cash? Are we going to actually see deleveraging and debt pay down? My expectation there is probably not, given just how cheap borrowing costs are right now. And instead, I think that we're going to see a lot of cash siphoned back into the equity side of things through dividends, share buyback programs. And that's actually the more challenging fundamental catalyst that I'm looking for right now. I feel pretty confident about most issuers' ability to manage through some of the supply chain and inflation headaches. But once we start directing cash towards equity holders instead of into the business or towards bondholders, then that's where fundamentals start to get a little bit more concerning.
It feels like the question for equity investors when it comes to, say, value, if you have higher inflation, if you have higher rates, you would think that means you're going to have a shift into value, which leads you to kind of Europe. But I wonder what the knock-on effect then is when it comes to the credit market there and sovereigns over there. Is there like an equal kind of trade to that?
That's a little bit harder to say. In the European credit markets, we've also been focused much more on taking credit risk rather than duration, looking for things like hybrids or the energy sector or AT1s where you're still getting some yield and relatively short duration. Now, the European credit markets do benefit from shorter duration relative to the US overall, but absolute yields are just so absolutely low that it's really hard to look at that and say, this is the time to really go in whole hog right now. But one of the things that I think is really interesting is the European credit markets have been very resilient amid the broader volatility and backdrop that we've seen.
What about the rest of the world? We've talked about the US, we've talked about what is happening here in Europe. How infected could global credit be by, for instance, what's happening with Evergrande? We were talking to Bruce Richards from Marathon a few minutes ago just about this subject. I'm wondering if there are factors that could knock what appears to be a very solid credit picture that you've just laid out off course, and do some of those risks emanate from outside Europe and outside the United States?
I think that's a really good point. Investors have been keenly focused on the Evergrande situation. I think right now the general view is that a takedown of Evergrande and a default there is probably not going to have global systemic issues, given that much of the global banking community is fairly well insulated from really outsized exposure. And that's where you would start to get very concerned about kind of global contagion. But the reality is that Chinese growth and GDP is pretty significant for global growth. And so if you start to have a deceleration in China, then you do start to feel the effects further out across the world. Now, the offset to that is then you potentially have a little bit less pressure on central banks to be aggressively in the current context, tightening monetary policy. And so there are some kind of gives and takes there. But clearly China and kind of how the Evergrande situation plays out and the implications for growth there and then global growth is something that we're monitoring pretty closely, particularly in conjunction with all of the U.S. debt ceiling negotiations or non-negotiations that are occurring right now. It feels like we could have a little bit of a perfect storm.
Negotiations or non-negotiations, I think it's like perfectly said. All right, Winnie, thanks a lot. Winnie Caesar of Credit Sites. Good to get your perspective. Coming up, there's a lot of risks out there. We just talked about Evergrande. There's also the debt ceiling. There's the budget funding. What are some of the biggest ones for 2022? Eurasia Group is out with its annual report. Ian Bremmer, Eurasia Group president, will be joining us next. This is Bloomberg.
Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. Congressional Democrats are at an impasse. They've hit a wall in an attempt to deal with three crucial issues at once: avert a government shutdown, prevent a debt default, and move forward on President Biden's $4 trillion agenda. Senate Republicans are blocking an attempt to raise the debt ceiling. Meanwhile, Democratic progressives and moderates can't agree on the giant tax and spending package. In Japan, Fumio Kishida is set to become the next prime minister. The former foreign minister won the leadership of the country's ruling party and is expected to be named to succeed outgoing Prime Minister Yoshihide Suga. Kishida has promised tens of trillions of yen in spending. He'll face an immediate test of his border appeal in a general election that must be held by November. The US and the European Union are expected to kick the inaugural meeting of the Trade and Technology Council in Pittsburgh today with an announcement on semiconductors. It will focus on shorter-term supply chains. Biden administration officials also told reporters there will be commitments on artificial intelligence and global trade challenges. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. So as Ritika was just talking about, you have U.S. and EU officials meeting in Pittsburgh talking about the global chip shortage. That's just one problem facing the global landscape for the rest of this year and really into 2020. Joining us now for more is Ian Bremmer, Eurasia Group president. Now, Ian, you guys just did a report that you put together with Axiom Global Risks. You interviewed a lot of individuals, a lot of companies. What did you find is what they see are some of the top risks right now?
Well, the good news is that for the first time in a couple of years, the pandemic is not on top of the list, and it's because people do recognize that we have the tools to respond, even if it's taking longer and there are stops and starts. But on climate and on cyber in particular, at the top of the list, getting much worse than previous years, and understanding that there isn't global leadership, there isn't global coordination, and as a consequence, the challenges are growing.
In terms of how that challenge is going to grow, ultimately, are we settling down into what some call a new Cold War? China, obviously, a big part of American foreign policy focus right now. Russia, when it comes to the cyber story, front and center. Are we basically getting back into that kind of a mentality where we are segmenting the world? The global story is gone.
No, the global story is gone, but we're not heading into a new Cold War. And there are two reasons for that. The first is that if you look at the global economy, most of the key participants in the American economy are either maintaining steady state interdependence with China, or they're increasing their exposure into the PRC. A few are decoupling, and those few do indeed matter, but the politics coming from Washington and Beijing don't reflect the underlying economic realities, and that's really important. The other reason we're not heading into a new Cold War is because in both the United States and China, there is increasingly inward focus. The bigger priority in the United States is $3 trillion on infrastructure. The bigger priorities in China are things like Evergrande and trying to get their technology sector under control, their private sector from the government. And that creates an enormous lack of global coordination, but not because we're fighting the Chinese, rather because neither country really cares about global leadership. Very different kind of scenario.
But then at the same time, Ian, it feels like everyone wants to collaborate or work together on climate change. And even when it comes to, say, France and US are a really good example. They're going ahead about, the submarine issue. France is still really upset about that, but then we're all supposed to go to COP26 and be happy. So, how do we work together on these things and then not have global leadership on anything else?
There is a lot more grassroots movement towards renewable energy. And that has translated into corporates, financial institutions, and the EU doing a lot. The United States, of course, did nothing for 4 years. Now we have a president that's focusing a lot more. But an announcement that we're going to be net zero by 2050 is very different from something that's actually passed through Congress that shows how we will do it. We don't have that. China, the largest emitter of carbon in the world, 2060 net zero plan. No idea how they're going to get there. They just last week announced they'd stop doing coal financing outside of China, but they're not doing any coal financing outside of China. Having said that, in the last year, there's been more new coal investment inside China than the rest of the world combined. So this COP summit coming up, you're going to have virtually no coordination between the US and China, and very little trust between the wealthy countries of the world and the developing countries of the world, who are being asked to do a lot more, but they're not being financed for it.
But let's come back to the issue that Alex raised, Ian, and that is that China is into linkage. It wants to link different issues together. It can't segment them into different buckets. Its foreign policy kind of links what is happening on climate with submarines and geopolitics. How do we make progress in each of these different silos and avenues if the Chinese are linking them together? Because they're all going to move at different speed and they've all got different issues.
Yeah, I mean, the fact that there isn't a Cold War doesn't mean there's trust, doesn't mean that there's any sort of cooperation or even managed competition. The competition that's occurring between our two countries right now is unmanaged. And you're right. The Chinese government is basically saying that unless we're sitting down and talking with them on how to work through our challenges on artificial intelligence, on semiconductors, on trade and IP, and cooperate with them, they're not prepared to cooperate with us on things that we want, like climate. And I don't see that happening in the near future. I don't see a breakthrough, precisely because inside the United States, Biden said we're not in a Cold War at his UN General Assembly speech. But we all know that one of the foreign policy issues that the entire American political spectrum agrees on is we want to take a harder line politically on China. We want to boycott the Olympics, at least diplomatically, coming up in Beijing next year. They're ripping off our IP. They're engaged in malware attacks against the United States. They're building up their military capabilities. Look at Hong Kong, Taiwan, the 9-dash line. I mean, it's a long list. And I don't see a breakthrough between the Americans and Chinese anytime soon.
How do you categorize the relationship between the U.S. and Europe right now? And what risk might that pose, or not, in 2022?
I think that the Europeans, clearly Brexit was a big problem for the transatlantic relationship. It is the country that the Americans are not only closest to, but also most strategically aligned, because we both think about national security and intelligence and surveillance and the Five Eyes Agreement, more engagement in the Indo-Pacific, all of that. Now that the Brits are out, all the Europeans have their focus really on national security. It's the French. But the French are the third largest military exporters in the world after the US and Russia. And they compete with the United States. They talk about strategic autonomy. They aren't as aligned. And the rest of Europe doesn't see the world through a national security lens at all. They focus more on economics and commercial interests. So it means that the baseline of the US-European relationship is not only less coordinated, but it's less important. The Americans are pivoting into Asia. They're focusing more on the Quad, where Biden just had that first in-person meeting in the White House a week ago. They're focusing more on the new defense pact with the Australian and the UK, while the Europeans not only no longer will have Merkel, who has been the strongest leader from Europe and also aligned on multilateralism for the last 16 years, but they aren't as coordinated or as trusting of the Americans. And that is almost as true with the Biden administration as it was with Trump, which is really quite something.
So where does that leave Europe? What does Europe do next? As you say, we've got a French election coming up as well, so who ultimately knows who will be in the Elysee this time next year? Where does that leave Europe? What are Europe's options if it wants to be more relevant in this world that sees the US pivoting towards Asia, towards China?
Where does it leave Europe? It's a centrist but weaker German chancellor. It is Macron probably winning, but with almost 45% of the French populace supporting people like Zemmour and Le Pen and Mélenchon, who are, strongly anti-establishment, burn it all down types. Mario Draghi is fantastic, but it's Italy. New prime ministers happen every few months there, right? So what it means is weaker individual government leadership by countries in Europe, but Brussels and Europe in terms of regulatory leadership, not on national security, but on climate, on trade, on tax, on data, on privacy, actually mattering more. So look, in a world where the United States and China are turning more inward and having their own domestic challenges, frankly, there is more space for the Europeans, but not in terms of the kind of global policeman role that the Americans used to play, because that's just not where European power is. And it's not an interest that any of the Europeans other than the French actually have.
Hey, and quickly before I let you go, one could argue that President Biden has already made some significant policy mistakes. What's the biggest risk that the U.S./Biden administration does now?
The biggest risk, I suppose, is that they fail at the $3 trillion in domestic spend that they're trying to get, because that would be by far the single biggest thing he needs to accomplish as president. Again, domestic, not international. Having said that, it is an enormous priority. Part of the reason they screwed up on the AUKUS deal and on the Afghanistan execution of withdrawal is because it just isn't a high priority if the allies in Europe or the Middle East are upset with Biden. Biden's overwhelming priority, and everyone is rowing in the same direction on this, is ensure that the progressives, as well as Manchin and Sinema in Senate, get together to get these trillions of dollars done. It's not quite a new deal, but it's by far the biggest piece of legislation you'll see in the United States in decades. And if that happens under Biden, it matters.
Always a pleasure, always insightful. Ian, thank you very much indeed. Eurasia Group President Ian Bremmer. This is Bloomberg. So after being battered yesterday, European stocks bouncing back today. Some people are talking about it being a dead cat bounce, i.e. not that convincing. It is being delivered on reasonable volume, so that's worth bearing in mind as well. And you have to wonder what the genesis of the price action was yesterday. Was it an inflation scare? Was it being driven out of the UK? Emblematic maybe of some of the supply chain shortages we're seeing around the world? Or was it fears about what's going to happen with the United States and what's going on with DC in terms of the funding story? Anyway, today we bounced back. The FTSE's outperforming once again. It outperformed yesterday, up by 1.2%. Remember, the pound is going down. There's a mechanical process in terms of translating earnings. Anyway, the sterling story may be giving the FTSE a boost. The CAC's up by 0.9, the DAX is up by 0.7%, the Swiss market up by 1.5%. This is how the session looks. Doesn't really capture the gap higher first thing this morning, but we did get a gap first thing this morning. That took us up to here. Then a reasonably tight range, kind of drifting sideways. 455. Remember, we've been up to 475 on the stock 600, so we're well below where we were then. Though if you take a step back and take a look at the longer-term charts, it looks much more positive. Today, stock 600 up by 0.6%. Let's talk about the sector rotation story. This is what we're looking at in terms of what we're seeing moving today. We did have yesterday, obviously, a fairly big emphasis on what is happening with the oil and gas and the mining story. That gave London a little bit of a boost. Today, we're seeing the car sector bouncing back. The banks are up quite strongly. Healthcare getting a bid as well, which is interesting. Retail and then the food and beverage sector. Bottom end, there is concern about longer duration assets, particularly when it comes to the tech sector, and concern that actually European tech in particular, if we are going to see a change in the rates environment, might look vulnerable to that valuation story. Let's talk about some of the single stocks, some of the names that we're focusing on. A downgrade today for Royal Mail. The concern here is that the logistics businesses, and Royal Mail is big now into parcel delivery, are suffering from labour problems, labour shortages and labour costs. and that is going to really impact the middle of the P&L, really impact the margin story. Royal Mail downgraded on the back of that. At the other end of the spectrum, the e-commerce story at Next, the UK retailer, clothing retailer, home interior retailer, again, coming through, storming numbers, upgrading their figures once again. This is, I can't remember, it's the second or the third time they've done this. But again, the power coming through from their e-commerce platform really delivering for Next. ASML. The lithography company out of Europe. It builds the kit that you use to build chips. And as we know, there is a shortage of chips out there at the moment. And as a result of which, ASML out today really pointing to a long-term cycle of very strong demand for this. It was interesting to see the Micron story in relation to this, but nevertheless, the kind of the kit manufacturers certainly seeing a very positive story going forward from here, Alex.
Yeah, and just want to update you here on Warby Parker. It's a direct listing. It's listing today. We're getting closer and closer. Right now, it's indicated to open at around 53.55. So moving ever higher as we're heading towards a full opening here on Warby Parker. All right, let's get more on ASML. Bloomberg's Ian King joins us now. I mean, ASML really painted 10 years of incredibly high surging orders and very, very strong demand. Why is the stock down?
I mean, you look at this company and it really, it's up more than 60% this year. And the reason that its stock is up more than 60% is everybody knows that if you want to make chips, if you want to make the most advanced chips, this is where you go. You absolutely need their machines. There's really nobody else that competes with them particularly one type of technology that's become absolutely essential to making the chips. But that's a widely known thing. That's no secret.
In terms of how strong demand is going to be, how short is the market of the kit that makes the chips? Like, how much are we talking about here?
Yeah, I mean, it's not a shortage of the machinery per se. It's more the lead times. I mean, if you told me, hey, let's make a chip factory, should we start production tomorrow? I'd be telling you, no, that'll be $15 billion and probably 18 months before we can even think about opening the doors to production. So that's what you're talking about here is inertia. So all of these companies that are saying, oh, I need to ramp up my investment, I need to ramp up my production, have ordered ahead of time. And, you know, ASML is one of the biggest beneficiaries of that because you don't get a machine tomorrow, you get a machine 3-6 months' time.
Yep. That is a serious lead time story. Ian, we're going to leave it there. Thank you very much indeed. Greatly appreciated. Ian King on ASML. Automakers certainly focusing on what the chip story is, stepping up their pivot to EVs. Earlier, we spoke to Lucid Motors CEO Peter Rawlinson.
Well, we're pushing to as hard as we can to satisfy as many as we possibly can. We're going to ramp production up significantly. But, you know, what really matters right now is getting the quality right, not getting rushed into just driving numbers down the line, making sure that each customer receives a great quality product. And then we're on track to ramp up to 20,000 units next year with a target of 50,000 in 2023.
Lucid, relatively new on the block, certainly compared with Rolls-Royce. It's been around a little bit longer, but today it is making its pivot. Rolls-Royce announcing that it is going to stop making internal combustion engines by 2030, announcing today a new vehicle. It's going to be called the Spectre. I understand that there is no relationship between obviously the Bond movie coming out last night and this new vehicle being confirmed today. CEO Torsten Müller-Ortfoss joining us now from Rolls-Royce to give us an idea of where this company is going next. Torsten, let's talk about the pivot to EV. You said in the past, and you've said it a number of times, that you want to hang on to the ICE engines, the V12, for as long as possible. That's actually a quote from you, for as long as possible. Why are you accelerating now this move to the EV? Why make the decision now? Why not hang on to those ICE engines?
No, I think I still, first of all, hello, and it's great to be on the show. I think with Spectre, we will now start to introduce electrification step by step in our model range. And as you rightly pointed out, by 2030, it is fully electrified. But that still means 9 years to go. And rest assured, we are proud about our 12-cylinder, and I stick to my word that we will carry it as long as possible. So the last 12-cylinder we're going to sell will be in 2030. But in between, we need to prepare ourselves for what I say is the next kind of generation for propulsion. And that will be electric. We've decided that for our brand, and we will go electric. It fits perfect to the brand. It is as silent, as torquey as our great 12-cylinder engines. It delivers what we call waftability, this flight on land feeling, and for that reason, well suited for Rolls-Royce. We are not defining ourselves about engine noises or combustion sound or exhaust pipe sound, and for that reason, electrification is spot on for us. And it is not accelerated. I think we are proud that we are the first ones in that super luxury segment going full electric. That's rightly so, and from there we go. Then the next steps to come.
I hear you that you don't think that the strategy is different from what you've laid out before, but your parent BMW is just doing it differently. They're going to make combustion engines, hybrid, fully electric cars. They're going to do all of it while you transition to 2030 and just do then EVs. How does that work internally?
Very good, because we are not what I would say in the car business. We are in the luxury goods business. Our customers are buying Rolls-Royces not for pure transportation means to come from A to B. We have very different driving patterns in our cars. They are mainly used for, I would call it, commuting into the city, commuting out of the city, using around cities, using the cars for, let's say, a weekend drive, a short one, but none of our client is really going long distance drives. And for that reason, electrification is perfect. Yes, we will offer a suitable and sufficient range in our car, rest assured. Also, you need to understand that many of our clients already own an electric car in their portfolio of cars, in their garages. So for them, it's not really new. And I think they all have charging at home. They have charging at their office locations. So it is not for us a big worry about the infrastructure. It fits well, and I think is right for us as a luxury brand. Whilst for regular car brands, to say it like that, I think the strategy to diversify into all sorts of different drivetrains is probably the right one.
What is it going to mean for the factory down there in Goodwood? How big a shift is it going to be in terms of the number of people you're going to need to employ? How important is the drivetrain there? How important will it be in terms of the way you're going to reposition the vehicles? I'm just wondering how big a shift this is going to be in terms of the sort of the nuts and bolts of building cars for Rolls-Royce.
It will be a shift, that's for sure. We are already in that phase to prepare the plant for building the cars. But one thing is also sure, it will be a true Rolls-Royce, and it will be handmade, crafted by hand. It will take far over 800 hours, as it is with all other Rolls-Royce models. Bespoke is obviously possible, up to your imagination. So it will be fully embedded here in Rolls-Royce at Goodwood. And for that reason, it is technically a big transformation that happens currently here in our plant. But from, let's say, education levels, from training levels for our people, that is something what we have started already a couple of years ago to prepare ourselves for that next step into electrification. So I think when this car ramps up in volume, end of 2023, we are well prepared that this happens. And nobody here within Goodwood needs to be worried about his job. We said that already. I think we have prepared ourselves in the right direction. We trained people into new qualifications, so that is all done and dusted already.
Torsten, we sort of ended the European close talking about ASML and the chip shortage and how they're going to see a strong decade of demand. I can appreciate how your buyers aren't price sensitive, so you may have some nice pass-through in terms of pricing. But can you give me some perspective on the shortages that you're seeing?
I mean, we are very lucky to be part of the BMW Group, and for that reason, we are well served with all semiconductors we need. Rightly so, knowing the contribution margins, knowing how profitable our business is, and for that reason, we are not running in any way short. we can satisfy the unprecedented demand worldwide towards our products. It is that we are sitting on an order book as strong as I've ever seen it, and for that reason we are in a good shape and well situated with semiconductors.
Torsten, one final quick question for me. We were just talking to Lucid Motors, and one of their big focuses is going to be on AI and autonomous. We're seeing obviously the same thing at Tesla. We're seeing the same thing. You look at Volkswagen, huge amounts of investment into software. BMW obviously making big investments as well. When you think about a Rolls-Royce going forward, how much of it is going to be about the physical product and how much of it's going to be about the software that goes with it? And how different will the experience be when we get to autonomous? That's not that far away, potentially.
No. I think autonomous will come also into the brand of Rolls-Royce. The question is when. Because all of our clients have access to a chauffeur. Obviously, you need to know that 80% of our cars are in the meantime self-driven, but chauffeur is always around. And the chauffeur is not only the person to chauffeur the car. The chauffeur is very often the right-hand assistant to the owner. And for that reason, something you can't easily substitute by artificial intelligence. So it is far more than just somebody driving a car. It is your friend, your secretary, who helps you in your daily life. And for that reason, probably not so easily to be substituted. But definitely the time will come, then also Rolls-Royces will be autonomously driving. But we are doing it at a time when it fits and suits our customers. That drives us, nothing else.
Torsten, we're going to leave it there. Thank you very much indeed. Rolls-Royce Cars CEO Torsten Müller-Ötvös joining us from Goodwood, Chichester. Let's talk about where we are with the European stock market. We have settled. These are the final numbers, a positive session, a bounce back from yesterday. The FTSE outperforming, up by 1.1%. Next, a real standout story for the London market today. The DAX up, the car makers, just talking about that, trading strongly today. The CAC 40 up by 0.8%. This is Bloomberg.
This is Bloomberg Markets European Close. I'm Ritika Gupta live in the principal room. Coming up, United Airlines CEO Scott Kirby. That's at 1 p.m. in New York, 6 p.m. in London. This is Bloomberg.
Live from New York, I'm Alex Steele with Guy Johnson over in London. This is the European Close on Bloomberg Markets. One of the biggest risks coming out of D.C. is debt ceiling. You have a budget and you have two infrastructure bills. So President Biden's facing a pivotal day in Congress today. From where we turn to Bloomberg's Washington correspondent Emery Hordern, who's at the Capitol. Every day feels pivotal. Why is today extra pivotal?
There's a lot that this administration is trying to get done in Congress. First, we should talk about what's first on the list, which is avoiding a government shutdown, which would happen at 12:01 a.m. on Friday. This morning, speaking on the Senate floor, Senator Schumer said that they're going to move an action on that. And this would be more of a clean bill. This would not include the debt ceiling, which has become controversial between the two sides. So potentially that gets dealt with today. But then Senator Schumer said that they will not go through reconciliation to avoid the debt ceiling drama. Now, Republicans are insisting that Democrats do that on their own via reconciliation, and Democrats are urging them to do this either bipartisan or at least allow just a simple majority vote in the Senate. Right now, the Republicans say no. So those are the first two things. The second is, of course, tomorrow there is supposed to be a vote on that hard infrastructure agreement, but progressives in the Democratic Party are doubling down, and they are saying that they can tank that bill because they don't see enough being done yet on reconciliation. And the people who really have the keys to unlock that negotiation are the two moderate senators, Senator Manchin from West Virginia and Kyrsten Sinema of Arizona. And they have been meeting personally with the president, and we're still waiting to see whether or not there could be some sort of deal so that that vote can go ahead and they could sign up for. If not, potentially, this could be weeks or months of debating in Congress for the president's economic agenda. Not just embarrassing, but also we're in the middle of a pandemic, so it can slow a number of things down.
Yeah. It all seems to be stalling in a fairly embarrassing way for the president, potentially. Anne-Marie, thank you very much indeed. We'll look forward to see what progress ultimately is made. There do seem to be a lot of plates spinning right now. Let's talk a little bit about what's happening with the world of central banks. We focused yesterday on Treasury Secretary Yellen and Jay Powell giving testimony to the Senate Banking Committee. Today, we've got day 2 of the ECB forum. It used to be called Sintra, but now it's a slightly different event. Basically, we are awaiting now a panel of some of the world's central banks. I think we've got Governor Kuroda speaking right now. I think we've got Jay Powell on this session. I think we've got Governor Bailey and, of course, Christine Lagarde. Joining us now to give a sense of what we can hear from all these different central banks is Bloomberg's international policy correspondent, economics and policy correspondent, Mike McKee. Mike, in some ways, these central banks are now increasingly on very different pages.
Yes, and that's what makes it interesting. They're all kind of in the same boat, reopening economies after the pandemic shutdown, but they're dealing with different problems. The ECB has inflation rising on a headline basis, but not so much on the core, and they still want to stimulate because the economies of the Eurozone are sort of running at different speeds as they come back out of this. United States, Jay Powell, we've heard a lot from him lately. They have a question of how far and how long do they let inflation run, because it's higher here than anywhere else, but also growth is stronger here. So he's in a different place. Kuroda, who is speaking right now, he has a new prime minister who's going to spend a lot of money on fiscal stimulus, or at least he says he is. So how does he handle that? By the way, this is the day that Kuroda becomes the longest serving of all of these central bankers. And of course, Andrew Bailey, he's in the unusual position of dealing with not just the pandemic reopening, but Brexit and the shortages that that's creating. And they have, well, you guy, have inflation that's high enough that the Bank of England, among those 4, is already talking about the possibility of rate increases.
Right, so talk about the sequencing a little bit, because if we look at the US and the UK, which will be inching more closely to tightening monetary policy in some capacity, the sequencing is very different. What are the different effects of that?
Well, it depends on how the timing works out. If the Bank of England goes first and raises rates, it isn't going to have a huge effect on the rest of the world. If the U.S. starts tightening policy, it will have a major effect because there'll be spillover effects to emerging markets, and those will spill over to some of the other big markets as well, some of the major central banks. The European Central Bank is trying to stay out of that. But the problem that Lagarde has is that what happens elsewhere bleeds over, and so people are going to be watching them to see if they can hold out and continue their efforts to try to boost the economy through monetary policy.
Mike, we were told time and time again that it was going to be easier to control inflation because central banks had a long history of controlling inflation and understood what the tools were than dealing with disinflation. Is that true?
Well, it depends on what you mean dealing with it. If you're talking about what kind of central bank response, yes, it's easier to deal with inflation because you raise interest rates. But we have found with low inflation over the last decade that just cutting interest rates doesn't raise it. And Japan has found over the last 2 decades that doing a lot of QE doesn't raise inflation either. And so if your inflation level is too low, central banks are a little bit constrained.
All right, Mike, thanks a lot. Really appreciate it. We want to listen in now to Christine Lagarde, who is now speaking at this revamped Sintra Forum.
Unusual recession followed by a very unusual recovery, and we are in that process of recovery. It's a very unusual recovery because it is the steepest recovery we have seen in the euro area since 1975. By the end of 21, the euro area will be back to pre-pandemic level and will move back to the trend that it was on before the pandemic hit us. So this recovery is very unusual, very rapid, and I would say that it has been largely attributable to the rapid vaccination campaign eventually, because now over 70% of the population over the age of 12 is fully vaccinated. It is attributable to the removal of the containment and the lockdown measures that have been virtually removed in all euro area, except for some social distance protection, such as the wearing of masks. But it has not stopped or reduced the activity both in manufacturing and in services, which have picked up significantly. And we have seen some interesting, reaction on the part of those who suddenly were sort of relieved and released, in the sense that we have seen a pickup of purchases of goods in particular, which was very unusual. And of course, the services now has been seriously accelerating, and we're using all sorts of unusual instruments to try to measure that. Mobility measurements in particular are clearly showing that people are going back to consuming services, and sometimes more than they had before pandemic. But contrary to last year, where we said that there was a sea of uncertainty, the sea has receded somehow, but we still have uncertainty. And those uncertainty operate as a threat.
You've been listening to the ECB forum on central banking. You got the Fed's Jay Powell, ECB Christine Lagarde, BOE Andrew Bailey, and BOJ's Harish Kyoda talking as well. So Lagarde talking about the fact that uncertainty is a threat to euro area growth, that euro area is back from the brink, but not out of the woods. A much more sort of conservative estimate that then you'd hear maybe from other central bankers like Jay Powell. You can go ahead and follow along with this on a Bloomberg Live Go if you want to hear the rest of the speeches. No doubt, though, that's going to be interesting to parse through the difference between, say, what Bailey, Powell, and then Lagarde might say and how they categorize growth right now.
I'm fascinated to hear what Andrew Bailey has to say. He seems to be changing the mood around the UK story pretty quickly right now. Balance of Power is coming up. David Weston will be at the helm of that. Alex and I are going to Bloomberg Radio. The cable up next. This is Bloomberg.